Hi, Adrian, into the questions box, just so I know we're all operating loud and clear. Seems to be all working, which is great. Yeah, we good? We happy? Fantastic. Okay, good. So, if you don't know how to use the chat box and you're watching on GoToWebinar, then what you can do is just see some instructions on screen here. All you got to do, depending on the type of device you're on. So if you're on like a computer or a MacBook type thing, it's going to look a little bit like this. You just open up the control panel here, brings up this bigger area here, and then you can type something in. Or if you're on a tablet, smartphone, it's going to look a little bit more like this, and then you've got the questions section there as well. So if you could just type something in, that's great. If you're not on that, we are also streaming on YouTube, LinkedIn, Twitter, indeed, and also on Facebook. So you just chat. I can't moderate everywhere, but I will follow on YouTube and I will follow on GoToWebinar, obviously. So if you've got any questions, fire them through on there, and we'll happily go through any questions you may have. But today, what we're doing is talking about scalping forex, really, and this is going to be something a little bit different. So I think when we normally think about scalping, we think about a particular type of trading. Quick, let's get some participation going. Do you guys know what I mean by scalping? Are you familiar with that term? You just type a yes or no into that questions box. That'd be great. Just so I've got an idea. Judy's got an idea. Jonathan doesn't. That's absolutely fine. Ultimately, what we're really here to do is to help teach, for people to learn. So yeses or nos would be great, please, everybody. Damien, not so sure, but a lot of yeses otherwise. So we're going to be getting into that, and we're going to get into kind of a take on it as to why scalping is good, but some of the problems associated with it, and how we can try and perhaps work around some of those problems. So today is a little bit my sort of take on scalping, which is something that, in my opinion, can work quite well for individuals who want to trade for themselves. So, for me, it's not always about what works best. It's about what works best for people. There are certain things that are great to do, but nobody can do them. So in which case, they're not great. It's that kind of a thing. And trading is very much like that. It's got to work for you, and that means it's got to suit you. Before we get into that, though, quick disclaimer. I'm not going to read all of this, but just to say, spread bets and CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay, so let's get on with it. Today, this is about getting in the position for growth. Now, there are certain attributes, certain types of traits, if you like, that are associated with the ability to make money more quickly. Okay, so I'm going to talk about some of those now, and these are things that are attractive. These are things that give us the greater ability to make money more quickly. The first of which is probably kind of obvious, really. High frequency. The higher the number of trades that you have, the more potential profit you can make, right? That makes obvious sense, because if you're risking, let's say, 1% of your account on each trade, the more times you are risking that 1%, the more times you could potentially make that 1 or 1.5%, 2%, whatever it may be. And therefore, the more potential you have, the more opportunity you have to make a profit. If you're only making 1 or 2 trades a month, then obviously the most you could probably make is 2, 3, 4%, let's say. But if you're trading 20, 30, 40, 50, 60, 80, 100 times, then you have greater potential. That's fairly obvious. So in order to be in the position for growth, you need something that can trade relatively actively, which is what makes trading more attractive to investing. And I know that some of this will be relatively obvious, but this is all again about making sure that we make conscious decisions about doing things in a particular way. All right. Low trade duration. One of the things that we're going to talk about today is the way in which markets move. That the way I like to look at the markets is they tend to have little bursts of speed, usually for 2 or 3 candlesticks, and then they tend to stop and slow down. Yes, fine, sometimes the market will just go hell for leather, but that's not really the normal. It happens, and it's great when it does. But the normal and the more perhaps likely scenario is that the market will sort of do things for a few bars, and then it'll go sideways for a few bars, and then it might carry on the way it was, or it might start to go back the other way. The point is that if you want to be in a position for accelerated growth on your trading account, low trade duration is normally an advantage, because the longer that you are in a trade, the more your capital is stuck in trades that are not going anywhere. Okay, so let's say that you're going to hold a trade for a week. It's probably only moving generally in your direction for 2 or 3 days of that week. The rest of the time, it's probably doing absolutely naff all, because within that long direction there is going to be a period of sideways movement. So the more that you are trading the faster part of it, the more that your trade is during the faster part of the move, the more you are using the capital more wisely, the more that you are making money, therefore, and have opportunity with that capital as well. So that generally lends itself towards trading over a lower, shorter trade duration, allows you also to recycle that capital, so it's not stuck in a trade that's not going anywhere. You're moving it from one trade that's going somewhere to another trade that's going somewhere. Does that make sense? So you're trading the speed, really, is where opportunity ultimately comes from. Okay. Fewer concurrent positions means more effective use of margin. And this is a really interesting one. And what I mean by that is that if I just take trend signal strategies as an example, you could apply it to this any type of strategy. If you're looking at multiple positions or multiple markets, then what you're probably going to do is, let's say you've got, I don't know, £5,000 of capital. You might allocate £1,000 of capital or margin to each trade that you want to do. Now, that allows you to then put 5 trades on, right? So why don't I use a pen here? So you're going to do 1,000 times by 5 equals your account size of, say, 5,000. Okay. So that's 5 trades you might have on at any one given time. If you do not have 5 trades on at any given time, you're not fully using your capital, are you? So sometimes, let's say you're trading 5 different markets, it might be that actually there's only a valid trade on at any given time on, say, 2 of them. In which case, you're only using £2,000 of your £5,000, which means you're only using 40% of your capital, which also means you're not using 60% of your capital, which means you are not using your capital as effectively as you might do. The reason this is important is because the more concurrent positions you have, which means to say the more positions you have open at any one time, means the more capital you need to have in reserve just in case you get a signal on any given market. So if your strategy is based on having 20 or 30 open positions, potentially, it could happen. Not everyone likes to trade like that, but I do. I think it can work quite well. What happens is if you've only got 5 trades on, then you're not gonna be using your capital so well. And yet, if you fully invest in those 5 trades, when more trades come up, you're not going to be able to take trades off and then put money into those other trades. It means that you are rather more restricted. If you don't have many positions open or many concurrent positions open, what that generally means is you have the potential, if you want to allocate more funds to each of those trades, which means you're more fully capitalized and so on. Now, this may not be for everybody, you understand. This is what I'm talking about here is in order to put ourselves in the position for more rapid account growth. These are the traits associated with a strategy that could achieve that. It's up to you whether you are interested in that level of risk, of course. So the fewer the number of concurrent positions, the more potentially you are going to be fully margined. Because if you are allowing yourself to margin for 20 open positions, if you've only got 1 on, that means you're not using a significant proportion of your capital at that given time, which means your potential for growth is, of course, reduced. The other thing from it as well is that when you're trading, the smaller the stop means basically the bigger the trade size. This is fairly straightforward. Do we all understand this? If you want to risk, say, 2% of your account on a trade, let's say that you've got a £10,000 account. 2% of 10,000 equals £200. Okay. Now, this is where it's interesting. The wider the stop loss for that trade, the smaller the stake be, even though you might be risking the same amount per point. So for example, let's say you had 2 trades setting up. One had a 100-point stop, and one had a, I don't know, a 40-point stop. We're going to regret saying 40 points because I've got to work out this maths on the hoof. Basically, what that would mean, if you've got a 100-point stop loss and you want to risk 200 points on the trade, 200 divided by 100 gives you your stake per point, which is £2 per point. That's a spread betting stake. Now, if you do that in CFDs, it's the same maths. You might need to do a different currency calculation. So it might be $200 at $2 a point, which might be 2 CFDs. Okay. If you wanted to do £200 risk and you wanted to have only a 40-point stop loss, so 200 into 40, what is that? £5 a point, isn't it? Is it? Yeah, £5 a point. That effectively means it's a much bigger trade size, right? So effectively, that means that you're going to, again, be utilizing more of that capital. And let's say that your objective is the same. Let's say your objective is 50 points, for example. Then 50 points at £2 a point with a wider stop loss means £100 to you, but 50 points profit at £5 a point means £250 to you. So what that effectively means is that the smaller the stop that you have, potentially the bigger the trade size you have, which means the more effective use of the capital you have, the greater the opportunity you have, and the greater potential you have to make profit from it. Again, this is with the risk caveat that your stop does need to be in the right place. Okay, so just because you want to put your stop tighter doesn't necessarily mean it means it should be as tight as possible. It's got to be in the right place for the strategy you're trading, of course. But these are the sort of the points I'm going through. This is what is synonymous with a type of strategy that can allow us to have growth. Now, what these are types of strategy that is again synonymous for scalping. Okay, so scalping lends itself to short-term trading. It lends itself to probably only having 1 or 2 trades on at any one time. It lends itself to being only in a trade for a few minutes, or 10-20 minutes, something like that. So very much short-term trading, and that's fine as a way of trading, but you know what, it really isn't for everybody. It just depends on if it's the type of trading really that is for you. Okay, so everyone, just a quick yes or no. Is this all making sense so far? Just let us know in the questions box. Quick yes or no. Let me know. Okay. Good. All right. So typically what you'd be thinking is right now, well, if I want to trade, I should be day trading, should be trading on a very short term time frame, 1 minute chart, 30-second chart, maybe something silly like that, where I'm going to trade very, very quickly in and out. The problem is that that's not appropriate for most people. It sounds great in theory, and I'm not saying that people shouldn't day trade or scalp. I'm just saying that for a lot of people, it may not suit them. And could be time, it could be personality, whatever it could be. But that doesn't mean that you can't incorporate these sorts of things into your trading if you don't have that amount of time. It just means you've got to know the right way of doing it. So is day trading the answer? Simply, you need to consider the best time frame for you. How much time do you have for trading and how much time do you want to put into trading? You could let me know on the questions box, is it A, B, or C? How much time do you want to actually put into trading? Is it 10 to 30 minutes a day? Is it several hours a day? Is it 6 or 7 hours a day? Is it A, B, or C? Let me know. Be realistic, please. Actually think about, do you know what am I prepared to actually commit to? Because let's face it, this all sounds great. We'd love to be putting ourselves in to maximize the amount of profit that we can make. But how do we do it? Well, we need to be realistic about how much time we're prepared to allocate to this. Because if the answer is really A, or maybe a bit of B, then you need to think quite carefully about how you do it, because trading on a short-term time frame will not be for you. You just won't work. Okay, the likelihood of it being effective and working for you is quite small, because I talk about this in other events really. It really comes down to trading the time frame that best fits you. Now, trying to rush your trading into 10 to 30 minutes a day for day trading, you're forcing it. It's square pegs, round holes. It's just not going to work for you. But if you've got a few hours, yeah, you could trade short-term charts. Absolutely. If you've got all day, you could absolutely, again, trade short-term charts. If you're more likely to be A, or then really it's not the answer. Okay. Some days B, sometimes A, and that's fine, Judy. A lot of people will be like that. What I want to go on is, I guess actually the answer is most people are on A, really. Most of the answers are on there. Chris, you're going kind of slow and you're halfway through. I'm not halfway through because we'll be talking for about 45 minutes to an hour. And in any case, education is important because if we don't know how to do something, then we do it all for the wrong sorts of reasons. We'll look at charts in a second, but we have to understand why to do certain things in a certain way. Okay. If you want to just go off and follow live trades, then fine, we will look at that, but it won't be till a little bit later on. Why is important. So the type of trading, though, that I want to talk about is still trading off a daily chart. And it doesn't mean to say that you can't trade for 10, 20, 30, 40 minutes a day and still pick up the right sorts of results. It's about understanding the right sort of markets. Now, this is a sample of a few trades I did a while back. Just some FX trades, there's an index trade in there as well. And what you'll notice is that I have the ability to trade reasonable size, okay, and the profits are quite nice. This is trades done in a particular day. But what I want you to do is just look at the differential between these. What sort of pips are we talking about here? Well, what is that? That's about 40 pips. That is about 40 pips as well. That's again about 40 pips, whatever it is. The point is that a lot of these trades are looking for small sort of bite-sized gains. Now, why is that? Because that's what the market's most likely to do, and it's because that's the way in which the markets move, typically. Very often traders are looking at the big kahuna move, that 300, 400 point move, which is fine. But the problem is, even when that happens, most of us have already closed out and taken profits before then anyway. So holding out for the 400 point move is actually pretty unrealistic, and it doesn't happen all that often. And in my experience, doesn't really lend to a particularly viable trading strategy. If you want to be in and out of trades quite quickly, then you have to be looking to get in and out quite quickly based on smaller targets, smaller stops, which means that then again allows you to be fully invested. And you can absolutely do that based on a smaller, trading something like a daily chart as well. Okay. Now, to give you an idea, Chris, you're asking about what sort of account size you need to do this. I go on the rough rule of thumb. Again, this depends on how many concurrent positions you have open. Some of you might only want 1 or 2 trades open, in which case the account size you have can be a lot lower. But I go on the basis that you need about £500, about $500 for every £1 a point you want to trade. Okay, that you then have to work that out based on the number of trades you might want to have open. So this is kind of a sort of a minimum. That's slightly what your broker would require. So in order for to trade that Swiss yen at £9 a point, you need about £4,500 on the account to be able to place that trade in the first place, because that's broadly speaking what the margin requirement would actually be with your broker. Now, you might want to have a bit more than that, but that's kind of the minimum really that's required. If you want to have more on that account, then of course that allows you to trade more positions rather than necessarily just loading up bigger size on that account. Percentage risk is, in my experience, very much a personal thing, because actually I could say trade 1%, 2% on your account, whatever it may be, but it's something that you have to be comfortable with. The more comfortable you are emotionally, like stress-wise, with the trade size that you're placing, the more relaxed you are, the better a trader and your better results will be. And that's got nothing down, and that's nothing to do with trading 1% risk or 2% risk or 5% risk. That's simply down to how you are as an individual, really. Okay. So what I want to do is just talk about what I'm going to be looking at today. I'm going to be looking at foreign exchange. Why foreign exchange? Because, when you don't have a huge amount of time, you want to trade markets that move broadly in the same sort of speed. Okay. Would the frequency of these trades not increase the broker's charges, Frederick? Well, it depends really. A lot of brokers now, you don't have to pay commissions on Forex. Spreads are really low. If you're only in a trade for a day, my average trade on this strategy is like 1.4 days. So my cost of carry is very, very low. So actually my costs are quite low, to be honest with you. It depends. Obviously the more active you are, the more costs come into it. So you want to trade with an efficient broker. Some brokers are more efficient than others, that's for sure. But you know what? With competition the way it is now, a lot of them are pretty pretty competitive. So these are the markets that I'm going to be trading. So, we're looking at more of the major sort of currency pairs, the more active currency pairs where they're more liquid, the more actively traded, the margins are fine, the spreads are low. I'm not really interested in scalping over the daily chart on something like a peso or a forint or something like that, simply because, it's just going to cost too much. If you're trying to look for 30 or 40 or 50 points on a trade and you're giving away 30 points in spread, you're not really ever going to make any money on that. All right. Okay. Low trade duration, my average trade about 1.4 days, but that's the type of thing we're looking at. We're looking to be in and out of trades more quickly. I'm going to show you that on a chart in a second as to why that is. Trading the momentum. Faster indicator settings. So normally those of you that are familiar with TrendZone already, I'm going to be talking about the D1 Accelerator strategy now, and the way in which we can incorporate those elements I talked about before by trading on a once, twice a day type strategy. But we're going to speed up the indicators. Why? Because I want to get in trades more quickly. I want to get in trades as early as possible and be out of them as early as possible as well. How about the Dow, the Nasdaq Gold? You can absolutely trade those with this strategy. The point about this is, though, that you need different amounts of capital. Your stake sizing needs to be a little bit lower. So it just means there's a few extra things to think about, Joanne. So I'm not against trading those markets, and we'll have a look at the DAX today. But it's just that it just incorporates a different type of thinking. Whereas FX broad, I know some move a bit faster than others, like pound New Zealand, pound Aussie, but broadly speaking, they move at a similar speed generally. Whereas compared to FX, indices are probably 5 times the speed. Okay, so it just means that what you tend to find is when people are trading quite quickly, quite actively, they don't tend to vary their stake size too much. They tend to do £1 a point on everything or £2 a point on everything. You couldn't do that same thing with an index. You'd have to reduce that by quite a bit. Just requires a little bit more thought. Okay, and I can trade these markets typically with tighter stops, targets, which then therefore allows me, Joanne, to trade with bigger trade size. And what I look for is a momentum strategy. So I look for turning points that follow major trends, major directions, and I look for a burst of speed for the next 2 or 3 days. Okay. Let's be going through that in a second. These are the results of the strategy. A lot of you be familiar with this for the D1 Accelerator anyway. There are loss-making months with this strategy. This is on a percentage risk basis, and that's fine. There'll be loss-making months on any given strategy, but you can see the sort of the ballpark around that sort of 13-14% average per month there. That's risking 2% of your account on each trade using this particular strategy. Let's have a quick look at some charts. Let's quickly understand this. This is a snapshot from a while ago. It doesn't matter. This is just simply about the strategy. What I've got on here, a few things I want to point out. My favorite opportunities using this strategy are pointed out by these discs on the charts. Okay, now this is automatically generated using the software that I use and other Trend Signal members use. This is basically identifying for us the right types of patterns. Now that could be monthly trends, weekly trends, intermediate like the daily chart price direction, the degree to which markets are overbought, oversold, ascending, descending chart patterns. A lot of that is factored in. That's the way in which we like to look at these markets. Ultimately, whatever we're looking for at the market is whenever this line, this green and red line here changes color, it gives us a rotation, a turning point. What we are then interested in as traders, as trend signal traders, is looking at the context for that change in direction. So when this line, like here, turns from green to red, that's telling us that this market is starting to turn down. Is that pattern associated with a downtrend in the monthly trend, the weekly trend, and so on? If it is, you'll notice certain lettering and you'll notice the discs on the chart. If it isn't, then you won't. And the whole purpose of this is to give a quick snapshot of whenever that line changes color, whenever a turning point is in play, as to whether it's a good looking setup. The best looking setups, the ones that have historically produced the most consistent opportunities, are marked with one of these discs on the chart that's all automatically plotted. The ones whose results tend to be a little bit more inconsistent, we need a little bit more discretionary sort of flavor to it, don't have a disc. Okay, does that make sense? So whenever you look at a chart, very quickly, you have that eye-catching ability to identify a favorite opportunity. Okay, does this make sense? Now, the reason I'm bringing this up in terms of scalping and the ability to trade quite quickly, one of the things that you'll notice on the chart, and this doesn't matter whether we've got our indicators on here or not, you'll notice that the market tends to move in little bursts of speed. That's a 2-day move down, a 3-day move up, a 2-day move down, what's that, a 4-day move up, 3-day move down, 6-day move up, whatever it is, 5 or 6-day move down, 4 or 5-day move up. 7 or 8 move. Do you know what I mean? It's not. A lot of people think that moves like this happen all the time. They don't. Okay, and to therefore construct a strategy based on what the market is and doesn't do very often is misplaced. That's not misplaced. That's the wrong word. It's not the right thing to do. A strategy should be based on looking at what the market is more likely to do, because that's where we have the ability to really understand the market and trade according to what the market is likely to do, because that's where the profit is. What you notice whenever you look at a chart, yeah, sure, you get some markets that overextend, but very often the market will burst for 2 or 3 days and then it'll pause. And then it'll burst for 2 or 3 days, then it'll pause or go the other way. Again, this happens time and time again. If you look at any chart, I would encourage you to go through it. Just look at the candles themselves. Sure, you get these bigger moves from time to time, then it pauses, then it has a big move, then it goes up, then it pauses, then it goes up. This is very, very normal. And we need to ensure that we have a strategy that can take advantage of that. And one of the great things, and one of the reasons we speed the settings up for this particular strategy, is that when we start to get that new burst of speed in that direction, that line from red to green changes that bit earlier, which allows us to get into that trade that a bit earlier, that allows us to take the trade for the next day or two. So when you see a move like this, there's a buy here. We've had a burst of 1, 2 days, and we're out within the next day. Here, 1, 2, move up for 2 days, we're in, because we're looking for a 3 or 4 day move. Okay, we're then out before the market starts to turn back around. And look, the market then stops, goes back the other way. And again, a buy after like 1, 2 days of up move. We're expecting another 1 or 2 days of up move as the most likely scenario before the market stops and reverses. I don't care what it does after that, because that's what I expect it to do. The market then moves down. I expect them to carry on for another couple of days, and then it stops and then it goes back the other way. These patterns repeat themselves consistently. And you'll see lots of charts that are very much like this. Absolutely. Again, is this, let me know, everybody, is this something that you've seen yourself as well? Is this something that you're familiar with? Is this something you see in the charts as well, guys? Again, you can let us know in the questions box. Yeah, quite a few yeses. So in which case, what we need to be doing is looking for that. Now, the more positions you have open, again, the more you have to water down the trade size you do. But this is something that I want to share with you here. What I've done on this chart is I've marked out the dates for each of these opportunities. Now, I appreciate this is a while back, but again, it doesn't really matter. So there's a trade there on the 5th of August, 13th of August, 28th of August, and pretty much all of them are out within like a day, maybe 2 days or something. And what you then see is these were the 29th, July, 11th, and 20th, and 21st, and whatever. You can all do the reading. What I want to show you is that these markets, whilst there might be a degree of correlation, that's not always the case. They don't always correlate, and sometimes they move slightly out of line. So it might be that the euro dollar, like we're seeing on the left-hand side, is moving fast at one point, but then pound yen isn't. And then you close out of euro dollar, and then suddenly pound yen starts moving quite fast again. The bursts of speed don't always come at the same time. And what I want to show you is what happens if we look at it like this. So when you line them on top of each other, you'll actually notice that there is space between them. Because if you look at this buy from the 11th of August, let's call it there. There's the buy. The next buy on that trade is the 13th of August. So 11th, 12th, 13th. The market's hit its peak. Okay, we've hit our profit, and then the end of that 13th day, we're out of trade A, and then we're into trade B. Okay, so by the time trade A is closed and we've taken our profit of what we actually expect it to do, which is move for a couple of days, we're then closed out, we've taken our profit, and then we've reallocated that capital into trade B. All right, so what we're doing is we're trading speed. The market then moves for a couple of days. Okay, we probably got out a day early, but then whoever knows? You never know exactly when the market's going to stop its speed. The market then stops and then starts to go back the other way. So we move from an element of speed here, we transition to that element of speed here, and then after that, well, look, there's no trades for a couple of days. We're probably trading something else. There might be another market, a dollar CAD or goodness knows what else, Aussie yen or something that's actually starting to move a little speed too. So we can reallocate the capital there rather than hoping that this market might put in a big move, but it probably won't, in which case let's find something else where it's about to or probably about to hit that sort of sweet spot. So by allocating some capital from trade A, allocating it to trade B rather than sticking in it, and then look what it does. It goes absolutely sideways. So if we'd stayed with trade A all of that time, we'd have only made that money on it once, and then we'd given it all back, and it's like, oh, for goodness sake, what a bloom pain. Whereas actually, by being nimble with that capital, what we've allowed us to do is recycle that capital into another trade, another 2 or 3 trades maybe, where we are giving ourselves additional opportunity to make profit. And you see that again here. Again, the 5th of August, that was actually a really nice trade. Did it in a day before stop. Then it goes back the other way. Then I get this one and so on. So it's about that ability to be nimble. Like I said, the more you are stuck in a trade, the more that's going nowhere, the more your capital is not being used as effectively as possible. So it's just about looking at 2 or 3 days. Yeah, there'll be some loss-making trades, of course there are. There's a couple of unpleasant trades actually, as there are, and that's okay. It's fine. It's normal. Doesn't mean they were bad trades. What we can do is again look to be a little bit more nimble. 16th of September. I actually remember this trade. I don't know why I remember it so much. I suppose probably because it's I've used it in these presentations a few times. But we had the sell trade there. We got out after a day. I took 50 pips out of it. And then the market went flying back up again. So we're in on the 16th of September. We were out on the 17th of September. Fine, lovely short trade. Took my profits, my pound of flesh out of it, and then on the 18th of September, the following day, had that short there on pound yen, which was a really nice short trade, hitting target on the 19th. Then again, you've got the ability to pick up a few more trades there. How do you know when to leave? Is it via TradeMate or are we just sniping? Typically, TradeMate is the starting point, Ebenezer. So TradeMate is a tool that we use to help us to manage trades. But of course, what you can do is you can use your own understanding of the markets for targets if you want to go beyond that. Typically, what I do is I use TradeMate as my starting point for an objective. If I don't have a huge amount of time, I'll just stick with that 100%. Sometimes what I'll do is I say, oh, that's just a little bit, target's just a little bit above resistance there. I'm just going to tighten it a touch there, Ebenezer, and I'll use that as my objective instead. But, really the starter limits on the TradeMate tool, the starter targets are the thing that we use. Okay. Just a quick yes or no then, everybody. Are you with me? Do you understand what we're trying to achieve here and the type of strategy that we're looking to take on here? Is this making sense? Now, I accept that not every strategy is for everybody. There's many different ways in which to make money. But if you're looking for something that continues to sort of give opportunity and continues to pick up the speed and so on, then something like this is designed really with that in mind, I would say. Okay, so look, let's have a look at some opportunities because this is fine, but let's have a look at some charts themselves, and we can see what we're looking at here. Now, what I've already done is run the scan for opportunities that's setting up for tonight. So looking at the trend signal charts, and then we can have a look at a few few other opportunities that have come up in the last few days and whatnot. In fact, actually, before I look at the scan, I think what I'd probably like to do is just have a look at. Again, I've given a couple of examples on the slides earlier, but it's all well and good me saying that's what the market normally does, but the difference between winning over the longer term is that ability to understand that not every trade is going to be a big buy like this. That ended up being a decent move. But a lot of trades are just going to be like this. And again, in football terms, this is like, I've been using the phrase winning ugly a lot lately. This is kind of like, a 3-0 win. It's like easy. We won that easy. Whereas this is grinding out for a 1-0 where you're scoring, in injury time or something. There are a lot of trades like that, and it is the difference to be consistently profitable. It is about our ability to grind out those difficult winning trades that allows us to be profitable over the longer term. That's really down to a deeper understanding of the market. If we can grind out a few of those extra winning trades, that's what tips the balance between being a struggling trader or an inconsistent trader to one that can be a lot more consistent there. And that's really down to a depth of understanding. The more of an understanding you have about the markets, the more profitable you can be if you listen to that understanding. I still, just because you experience doesn't mean that people still don't chase these massive moves. I look at this move here and I don't sit there and think, well, had I have taken that trade there, I wouldn't still be in this trade. I know a lot of market commentators and traders which would say, oh, of course I'd still be in this trade because it's gone up and blah, 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 blah. It's easy to say after the event and so on. I absolutely wouldn't. I'll be out after one day. And the reason I'll be out after one day is because that's enough for me, because I understand what this market is likely to do. I'd rather look at what the market will do 80 to 90% of the time than hold out for what it might do 10% of the time. Anyway, I'm probably laboring that point too much. The point is, an understanding of the markets and likely scenarios is important, because what you'll see here is there's the buy. Okay. Now, ordinarily, we like a nice tight stop. You see the intersection of the line there. That gives us what we call our our tighter stop there. Decent tight stop. Sometimes that's a little tight to give it a bit more width there, which we would do on this one. And again, this opportunity, we can give it a little bit more width. But some nice trades, decent reward to risks on these opportunities as well. Typically, the sweet spot. If I just have a quick look on these trades, if I look at let's have a look at this buy trade on Aussie New Zealand. We can use the semi-aggressive stop there. So we've got a couple of different types of stops. We teach you which ones to go with and so on. Our starter limits, our starter targets, is what we recommend for our new traders. Calculate trade details, and that'll give you the opportunity and it'll give you the risk for that trade. So you can see the take profit up to 110.55. The market goes up to 110.55, hits it 2 or 3 days in a row before backing off. And again, that understanding of what the market's more likely to do. We're not looking for the home run. Again, sport analogies, I always like that. We're looking for the quick single. We're just looking to get to first base. We're not looking for the home run. Why? Because most trades are not home run trades. All right. But if we can chip away at singles, eventually we'll get round. We'll get the equivalent of the home run, and it'll actually be a much more consistent result for us too. So what the TradeMate does there is actually gives us a little bit more confidence in terms of those exits, Ebenezer, as well. Now, it might be, if I look at this particular trade, you've got an objective at 110.55. I actually don't mind that as an objective. If you look at the, from a discretionary perspective, the market's hit that number there, and there. It's struggled to break through. It's about the right type of target for that opportunity anyway, Ebenezer, because the market's already tested it 3 times and started to back off. So, discretionary wise, it's actually at a decent level anyway. But what it's doing is saying it's looking at these and identifying them as the clearer trades. There's no sniper disc here. Now, why wasn't there, given that ended up being a really big move? Well, the reason it wasn't is because this pattern associated with here was not synonymous with a consistently performing trade. So if I looked at every trade that looked like this, okay, that had the context associated with this, because what we've done at Trend Signal, we've looked at every one of these turning points for our currency pairs, okay, and we've done it for the last goodness knows how many years, ridiculous number of years. And what we know, or what we have seen, is certain patterns over the last however many years that consistently produce the best opportunities. Those are the ones that are marked by the discs. The ones that tend to be a little bit more erratic or tend to have the lowest average number of pips per trade, we don't mark with the snipers. That's not to say that they don't have the ability to pick up a decent opportunity. It's just simply that you might just want to add a little bit more choice, discretion to it. Is it bouncing off support, and so on. But otherwise, new traders would tend to just simply focus on the sniper trades because those have historically produced the most clearest and consistent trading opportunities. So that's Aussie and New Zealand. Let's have a look at these that have come up in the scan. What we can do with the scan, the D1 Accelerator scan just simply looks for that color change in that line. Okay, so if that line changes color from red to green, it gives us a potential opportunity because a lot of our members are looking outside of the snipers because that's what we're teaching them to do as part of their development process. So what we can do is we can look at any of these FX pairs or beyond that and look for, look for opportunities, really, isn't it? So if I wanted to look at Aussie dollar, I can do that, and I can replace that chart there with the chart for Australian dollar against the US dollar, and what I can see there is a selling opportunity for there. So this is one that's setting up for tonight, okay? Why is it setting up as a sell trade for tonight? Well, because this line has changed from green to red. That makes it instantly attractive as a rotation, a turning point, but this move is in line with, well, the MT is suggesting in line with a downtrend on the monthly time frame. The market is also overbought, so we're above this 75 level, which means pretty much everyone who's going to buy it has probably already bought it, and therefore it's overbought, which means we've got an abundance of potential sellers. If there's a lot more potential sellers than there are buyers at these levels, that means they have the potential to drive price down quite hard. So the context of this move is effectively what we'd used to call a swing trade with the trend. So it's a big, potentially big swing trend. It's had a deep move against the trend, and we're looking for it to move back down. So the context of this is it's about to, we expect, to move back in line with those longer term trends, and it's a rotation that started there. And we would expect, based on this opportunity, the following. Okay, so let's say I wanted to go for the aggressive stop. I can do that. So just nice tight stop on this one, calculate trade details, and I can see it take profit of 71.33 versus a stop of 72.16. All right, and the tool will do that for us. If we want to go outside of that, use a bit of subjectivity, then of course that can be done, that can be achieved. And we even have actually, again, at the next sort of stage for us as traders, we could use the extended limits if we feel we're going to monitor those trades a little bit more. That gives us a slightly bigger objective for this one. All right, but that's a nice enough looking trade. And one of the things that you can do if you don't want to have too many concurrent positions on at any one time, like we discussed before, it might be a case of whittling this list down to one or two opportunities that you really like and be selective. So you might say, actually, I really like Aussie dollar, I want to take that one. But Euro Aussie, oh, well, look, there's no sniper disc on it. These two trades were nice, but there's no sniper on that one, so therefore I'm not going to take it. So you get to a point where you use your discretion, you make your choices. So actually, like, you know what? That's my trade. Aussie dollar, that's the one I'm going to be in, and I'm probably going to be out of it within the next 48 hours. Okay, we could look here, and there's nothing really to talk about at this point with Euro Aussie, Pound Aussie. Starting to turn back up again, but again, no sniper on the opportunity. Doesn't mean it might not be a trade somebody would take. It's bouncing off support back from, the 5th of May, but it certainly wouldn't be a trade that our beginner members would take. What's interesting about this chart is, and you look at a few sort of choppier kind of moves, again, this kind of underlines really what we were talking about before. That example I showed you was normal. Hit just like this. You have a burst of speed. Market went up for 1 day after the entry, but that's all that I need. Hit the target, come back down. The market went down for a day and a half after my entry. Fine. That's normal. Okay. And in recognizing that, it allows me to put my stop loss quite tight because I'm expecting that short-term boost of momentum for the market to carry on in line with that. And if it doesn't, then we kill the trade quite quickly, because if it's not going to carry on and hit target within the next day or two, it's probably not going to hit target. That's generally the way of things. And we pull the rug out of loss-making trades quite quickly. This one, there's the stop loss there. It didn't do it. We got out of the trade quite quickly. That's fine. Okay, this one, that had a really nice move actually. Within the first day, it's going on nicely before backing off. And again, this one moving on nicely. This kind of scenario, though, is actually relatively normal. But it doesn't mean that there isn't the potential for profit on there if we understand and recognize the way in which these markets are more likely to move. Okay, so let's have a look at a few other ones. There's plenty of charts that I can go through there. I mean, short-term trends, I wanted to show this on Aussie dollar. Again, it really demonstrates what the markets tend to be. Euro sterling was another one, by the way, that also really demonstrates the way in which these markets tend to move. 2 or 3 days, 1 day. That's fairly normal. Okay, that's a loss-making trade, but we're out of the trade after the first day anyway. That's okay. And then you have another trade there, which is again in a couple of days. Before again, it's backing off here. I think a lot of new traders, when they get into it, they're thinking about these big moves all the time, and they're not. But the funny thing is, it doesn't matter, because the relationship, your potential to profit, is really based on your stop loss distance, or how long you're going to be in a trade for. Because if you've got a trade that's a 200 point stop loss and a 200 point target versus a 50 point stop loss and a 50 point target, and you're going to risk, say, 2% of your account on each trade, the result is the same. If you win on a trade, you make 2%. If you lose on a trade, you lose 2%. The result, whether it's 200 points or 50 points, is actually immaterial. But what the 50 points does is allows you to put on more opportunities, allows you to understand the market better, and allows you to be more fast, more nimble with the account, which then provides you with a greater level of opportunity. You're going to be stuck in trades for longer, looking for 200, 300, 400 point moves. Most trades don't go to that sort of levels anyway. And then what generally happens is that the longer we're in a trade, the more doubt creeps in, the more we start to panic about opportunities we have open, which generally means the more we're looking for reasons to get out of the trade. So even if our target should be 200 or 300 points, invariably we're out well before 200 points anyway, usually because of a decision of fear. And again, what I tend to find is this is not about what works best statistically. This is typically about what works best for us as individuals, because it is us as individuals that are placing the trades. Now you might say, well, surely that's an argument for an automated trading system. Find me an automated trading system that works. I'm yet to find one. And in fact, I remember speaking to somebody, it was about a year ago now, who was trading one. And there's a group of them. The automated system put an error, wrote a couple of rogue trades on, and it blasted 95% of their account in a day. That's not a viable result for me. That's not something I'm interested in. I'm just interested in looking at what the market tends to do and looking to acknowledge that and trade really around it. Okay, that's pretty much it, everybody. That's the D1 Accelerator strategy. Guys, has this made sense today? It may not be a strategy that you're interested in, but hopefully, it's something that's given you a little bit of flavor about the types of trading that's out there, the type of trading you might be interested in doing. But if it's been of value today, let me know. Just type yes or no. No's okay. It's fine. I've got thick skin. But if today's been of value, let me know. Just type yes or no in the questions box. I'd certainly be interested to know. For me, I know that we could sit there and we can go through 1,000,001 charts, and I can call lots of live trades and so on. I've done that. I've done that plenty of times, but I tend to find it's the education where the real value is, because what we have to do is really understand why things are done in a certain way. Because if you don't know the why, then you're not going to follow anything properly. And I'm absolutely the same. If we understand why something's done in the way that it is, then you get that buy-in to what that strategy is trying to achieve, whether that's a trend signal strategy or whether it's any other type of strategy in there. You have to ask, why is it done this way? Because that way, if it is a successful strategy that you have, you will have the emotional desire, the ability to follow it properly and buy into that strategy emotionally, which means you're more likely to follow it. And if it is successful, you're more likely to be profitable with it too. Right, guys, that's it really. All the best, everybody. Gosh, I see a few questions coming through. I'll follow those up by chat in a second. But otherwise, everybody, thanks so much for attending. And I wish you all the very best as ever with your trading. Bye-bye for now.